My name's Ethan Braid. Today we're going to be talking about dividends for the S&P 500. We're going to be using SPY ETF for our analysis. We're first going to look at the dividend history of the S&P 500, and then we're going to estimate what our dividend stream might look like going forward for $1 million investment in SPY. The long-term growth rate on the dividend for the S&P 500 has been excellent at 5% compounded for the last 123 years. There have only been 3 time periods that the dividend came under any real pressure, and that was World War I, the Great Depression, and 2008. Otherwise, over the last century plus, the dividend for the S&P 500 has grown and been remarkably stable. Here's a look at the dividend stream that you would have received off of $1 million investment in SPY over the last 10 years. Making $1 million investment in SPY in the year 2014, the first year we received $20,767 in dividends. Our dividend yield that year would have been 1.87%. Total return on SPY for the year was 13.47. And what you can see is that there was excellent growth in the dividends over the last decade. 5.63% compound annual growth on the dividend. What I'm assuming in this illustration is that we're spending these dividends and not reinvesting them or reinvesting them somewhere else. Let's take a quick look at how dividends for SPY held up during the 2000 to 2013 timeframe, where we had not one but 2 recessions and huge drops in SPY. $1 million investment in the year 2000. That year we received $10,252. Notice that the yield was low back then, 1.15, and that's because the stock market was really expensive, overpriced. And also notice our ending balance really tumbles in those first couple of years in the early 2000s when the stock market gets hit really hard with the 2001 recession. But let's check out our dividend stream. Our dividend stream went down very slightly in the year 2001 and then recovered right away. So we had a recession in the early 2000s, but a minimal impact on our dividend. And then the dividend continued to grow. Then we see, here's 2008, and once again the dividend drops. And this was a severe recession. Notice that our ending balance is still well under where we started in the year 2000, but look at our dividend stream. It just keeps growing, even with a little bit of volatility in 2008. And we finish this decade, or decade plus rather, of 2013, with more than double the income that we started with in the year 2000, which is really encouraging to see, and a growth rate for the dividend during this time period of 5.88%, which is outstanding. If you had retired in the year 2000 and put a portion of your portfolio in SPY and then used the dividend for income, the results over the last 24 years have been excellent. Here's your original dividend of $10,252 in the year 2000. 24 years later, your dividend is up 4.5 times. $45,165 was the dividend in 2023. Your principal has grown to $3.2 million, and the growth rate over time on the dividend has been outstanding, 6.37%. Now let's take a look at how much dividend you can get for $1 million investment in SPY in 2024. The dividend yield for SPY is 1.32%. This is a low number relative to historical yields. There are 2 reasons for this. One, the stock market is expensive. The weighted average PE ratio for SPY is over 24 times. The second reason is that some of the stocks in the top 10 holdings do not pay a dividend. I'm talking about Amazon, Google, Berkshire. Other stocks in the top 10 holdings pay a very low dividend yield. This would be Nvidia, Apple, Microsoft. At the 1.32% dividend yield, we would estimate $1 million investment in SPY in 2024 would produce $13,200 of dividends. For most investors, the low yield on SPY is a reason that they cannot use it as a large position in their retirement portfolio. The volatility of SPY coupled with the very low yield, means that you could get into a lot of trouble if you were using SPY as a retirement income stream. For example, if you wanted to spend $50,000 of supplemental income off of your retirement portfolio, and your intention was to get that income stream off of SPY by just spending dividends, you would need to invest $3.8 million at the current dividend yield. That's just not going to be attainable for most retirees. Therefore, you would be left with having to spend capital gains if you were going to use SPY as a big component of your portfolio. This can be a slippery slope and you can get into trouble very fast when we get a recession and bear market. When the stock market goes down by a large percentage and you're spending capital gains in addition to, or principal rather, at that point, in addition to dividends, you can run out of money very quickly. So it really makes SPY as an income source unattainable for most people, in my opinion, and it kind of relegates you to using SPY as a smaller portion of your portfolio, albeit SPY provides excellent dividend growth and reliability of income over time. When I say volatility for SPY, here's a close-up look at what I'm talking about. This is the 2000 to 2013 era for the S&P 500, i.e. SPY, and you can see in 01 and 08, we had some very serious drops on share price. So if you were an investor and you were only spending dividends, this might have been more tolerable. But if you were a retiree spending principal and dividends, i.e. you're selling off a portion of SPY, in this environment, it would have been devastating for you. So let's add it all up. SPY has an excellent long-term track record when it comes to compound growth of the dividend stream. The long-term appreciation component of SPY is also excellent. Unfortunately, for most retirees, SPY is not going to be a great option for your retirement portfolio or shouldn't be used to any large degree because it has such a low yield and in the current environment, it's very expensive. For most people to attain a meaningful income stream off of SPY, they would have to have a tremendous amount of money to invest, which again is unattainable for most people, or take a lot of risk by selling SPY at certain points in the future when they think the time is right and manufacturing dividends by taking capital gains. And that's a very dangerous way to go about managing your retirement. If we enter an environment like the early 2000s, you would be forced to sell SPY at lower and lower prices, and it would only speed up the demise of your retirement portfolio. Therefore, for most retirees, SPY is going to be a smaller percentage of the total portfolio. I think it has an important place, but it should be a smaller percentage to protect yourself. You should be looking for income off of other types of dividend-paying stocks, ETFs, mutual funds, bonds, etc. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.